From volatility to value, let's have a look at the figures of capital markets Belgium and Luxembourg. 2025 delivered a year of contradictions. Geopolitical storms raged across global markets, intensifying economic headwinds everywhere. But here's what changed the game. Europe finally tamed inflation. The ECB capitalized on this advancement, implementing 4 rate cuts from 3% to 2%. Yet here's the paradox. Bond yields and financing costs refused to follow suit, staying stubbornly elevated despite these cuts. So what did this mean for investors? Let's dive into the numbers. In Belgium, investment activity showed a strong recovery. The total volume reached 4.5 billion euros. That's 42% higher than 2024 and in line with the 5-year average. This recovery was driven primarily by large industrial transactions, along with significant portfolio deals in retail, residential, and healthcare segments. For the first time, industrial and retail assets dominated investment activity, surpassing office properties. Industrial assets captured 28% of total investment volume, while retail and offices accounted for 24% each. The year 2025 marked a record-breaking period for industrial real estate, reaching an unprecedented investment volume of 1.3 billion euro. Luxembourg tells a similar tale of recovery in progress. Volume increased by 36% versus 2024 to 839 million euro, but still 11% below the 5-year average of 924 million euro. A solid growth, but not quite back to full strength. The office segment in the Grand Duchy remains dominant with a share of 55%, while other assets classes like retail and industrial posted good volumes. Let's have a look at the office market. In Brussels, we've seen a 27% surge in rents since 2020, hitting a record 400 euro per square meter annually, a peak that held steady through 2025. Luxembourg tells a more complex story. While the overall market rose just 6% to 640 euro per square meter, this modest growth masks shifts beneath the surface. While the traditional CBD stayed conservative, the dynamic Cloche d'Or district exploded with 7.9% rental growth. We're witnessing a complete geographic rebalancing of Luxembourg's office market dynamics. Another notable divergence emerges in office yield evolution. Luxembourg experienced a 25 basis point compression to 4.5%, close to the European average. This yield tightening reflects Luxembourg's enduring appeal as a stable investment destination, underpinned by persistently low vacancy rates that continue to attract investor confidence. Brussels, however, maintained stability, with prime office yields holding at 5%. Compression could emerge in 2026 given the low vacancy in CBD locations and steady demand for prime assets. What about logistics? Logistics claimed the crown as 2025's most traded asset class and was also the first to experience yield compression. Market fundamentals remain robust, with one of the lowest vacancy rates in Europe at 3% along the Brussels-Antwerp axis compared to a European average of 5%. Consequently, prime logistics yields compressed to 4.9% from 5.0% a year ago. Meanwhile, Brussels rental values jumped 12%. Why? Available space is minimal, construction costs are soaring due to expensive ESG requirements, now industry standard. Let's have a look at the retail segment. In the retail segment, rental values in the high streets have been recovering since 2023. The trend is visible in Antwerp and Brussels, and more strongly in Luxembourg. Looking at yields, stability prevails as well in all markets. The property investment markets in Belgium and Luxembourg are showing clear signs of recovery after a challenging period. Luxembourg has used 2025 as a foundation-building year, while Belgium has already begun its recovery trajectory, powered by strong portfolio transaction activity. Although single asset sales continue to lag behind initial recovery projections, the market fundamentals remain robust. Both markets have established solid results, with momentum building toward a more comprehensive recovery in the year ahead.